Retail real estate is one of the smartest and most overlooked investment opportunities in the world right now. And in this video, I'm going to show you why. I'm going to break down the numbers and show you why it's really a contrarian play that you should be taking advantage of. Stay till the end of the video. I'm going to give you a little bonus as well. All right, so let's jump into it. All right, let's start here. What does it mean to be contrarian? You hear the word all the time. Some very popular influencers, YouTube stars and so forth, they say contrarian a lot, and all it means is kind of going against the flow. It's contrary to someone's belief, and that's really all it is. It's just not doing what everybody else is doing, and it makes sense because if you look at the history of investing or making money, there's always these trends that are trending upwards and everybody jumps on, and if you jump on the bandwagon too late, you get there at the top and all of a sudden it drops back down. And people most recently will think of this as, they'll think of it with like Bitcoin, right? So Bitcoin's trending up and you bought at close to $100,000 and all of a sudden now it's 70 something at the filming of this video. Or back in the 90s with the dot-com bubble, and then real estate booms, and then in 2008 there's a crash, and that's just kind of what it is in the economy and just investing in general. There's always these ebbs and flows and these trends, and the thing that somebody is doing that not everybody else is doing is called contrarian. I don't really get how that came to be, but it just seems to me like it's the smart play, is thinking outside the box a little bit, seeing everybody is doing one thing and then moving to the side and doing something else. There's a saying by Warren Buffett that it's be fearful when others are greedy and be greedy when others are fearful. And I think that pretty much sums it up right there, is to think a little bit farther down the road and not follow what everybody else is doing. So if you think about some of the best real estate plays, it's always kind of when everybody else is sitting on the sidelines. And that's really what it is. If you had cash in 2010, 2011, when people were all scared of real estate, and you bought something up when things were at the very bottom, you probably made a killing. If you bought office space, back in the 80s, 90s, you probably made a killing. If you owned office space 5 years ago, the bank probably took it back from you. And then right now, I'm seeing a lot of investors invest in office space. There's a lot of the biggest CEOs in the world are talking about how they want their employees and their staff coming back to the office, and a lot of investment groups are buying up this office space, and they're buying it with tenants in tow, which is typically a retail move. Historically, when you buy retail, when you buy a shopping center, you want to secure your anchor tenant, is what it's called. So you want to secure a large grocery store, a Target, a Walmart, a Home Depot, Lowe's, something like that. You want to have your big tenants already signed into leases or really far down the line before you commit to acquiring that center or developing that center, building it from the ground up. So you're seeing that a lot in office right now with these groups taking down high-rises, mid-rise buildings and already having a tenant in tow to take 12 floors. And that's what you're seeing. So that's kind of a contrarian play too, but not the one that I'm here to talk about. So for over the past, let's say decade, maybe longer than that, maybe like 15 years, 20 years, the biggest thing in real estate you hear people investing in, or if they're regular people, okay, that's what I'm going to call just regular people, you and me type of people, they don't do this really professionally. They maybe have a W-2 job and they're doing this on the side. It's always self-storage. It's going to be single family rentals, SFRs, single family residential, then you rent them out, long-term rentals, short-term rentals, Airbnb. You're going to have self-storage, the rentals, boutique hotels, another one people are getting into a little bit. You probably heard that. Not so much industrial for like the layman investor. That's not really a big play. That's more institutional. But there's some people that have bought up some flex space and things like that. And that's kind of it. But multifamily, apartments, the duplexes, the triplexes, the quads, that type of thing. Small units, 8 unit, 16 unit, little apartment complexes. That's a big one too. But everybody jumped on that train. No longer contrarian as it was, 20 years ago. Everybody jumped on that trend. That's the big trend. What happened is when there's that much competition, just like anything in economics, you have a limited supply of apartment buildings and a massive demand. So now the prices of these apartments go higher and higher and higher. And when you buy one of these apartments at a higher price, you're getting a lower yield, a lower return of the income that is produced for your money. So now that's represented by a cap rate, an equation, which now you used to be able to buy apartments at 7, 8 caps, 10 caps if you're lucky in certain areas. Now they're like 4 caps, 3.5 caps. You're paying more interest on your loan than you would by getting cash flow. And so you'll be negative cash flowing some of these apartments. So what happened is people moved into Airbnbs, short-term rentals, anything like that, and even buying houses, long-term rental type of thing. They kind of got away from multifamily for a little bit. But as I was seeing this, I owned a construction management company. Work was going good. We did all sorts of different things, but I saw these retail centers that no one had paid attention to. And they were these neighborhood centers in suburban areas, and they just looked kind of run down, almost like people hadn't really paid attention to them, a lot of deferred maintenance and things like that. And the reason for that is because retail traditionally has a lease structure called a triple net lease structure. And what a triple net lease structure is, the tenant is in charge of paying not only their base rent, but the property taxes, the insurance, and the CAMs, which is common area maintenance. And basically, because the tenant has to pay that, a lot of times landlords don't really do a lot of maintenance because they don't want to have their tenants pay for it. They don't want to ruin their NOI, things like that. So shopping centers can get pretty grungy pretty fast over in the 10, 20, 30-year period. So we saw this and started seeing that rents are severely below market, coupled with the lowest vacancy rate in almost history when it comes to retail. And there's a reason for that, and this is why. So back around years ago, I don't have the exact date, there was about 220 million square feet of retail being completed and built a year. And this was right around, I believe it was like the recession. There was e-commerce was coming to the surface because it was starting to make a big impact, but not yet. But right around after the recession hit and e-commerce was making a big move in the industry and just in the world, retail started tailoring back. And now, if you look at JLL's numbers from last year, only 30 million of retail is being built. So that's 190 million square feet of difference in retail, which means the supply is going less and less and less, and businesses are still opening. So what happened is people assumed that certain retailers, well, they wouldn't assume, they saw. Okay, they saw that e-commerce, you have Amazon and everything can be bought online, and then retailers, mom and pop stores, people selling shoes and t-shirts and clothing and certain items were going out of business because you could buy it online. And it was not internet resistant, it wasn't e-commerce resistant is what it's called now. But what happened is those companies took off, or they went out of business. This was coupled with COVID, the pandemic era, which also put a lot of things out of business. And now you have a lot of vacant space. And instead of this vacant space staying vacant, other businesses moved in. But instead of it being traditional retail, it is now fitness, health-oriented, experience-driven restaurants, a lot of food operators, and things like that. So retail just evolved. And it evolved, and they didn't have a lot of space to move into. So demand started picking up, and there's a limited supply. So now what happens is basic economics, the rental rates now increase. That's why there's this play in retail right now, is because there's such a demand for it and a need for it, and a demand for small businesses that want to go into need space to open. I'm based here in California, in Orange County, and our vacancy rate in certain areas around here is 2 to 3%. It means you're seeing maybe one vacant space in a shopping center. I mean, if you think about it and you're watching this, and you're in your hometown right now, how many vacant shop spaces do you see? How many vacant restaurant spaces do you really see? Is it maybe that one drive-through restaurant, that one boarded up restaurant you're always talking about? Why doesn't someone do something with it? Is it that strip center with a 7-Eleven and there's like that 1 or 2 empty spaces? It's really not a lot. They stand out. Don't get me wrong. When you see one, you recognize it because everybody notices in their brain, their visual, they see vacant retail. They see a for lease sign, it clicks in their head, but it's actually a lot rarer than you think. If you think how many vacancies are in an apartment complex, it's always carrying 10, 15% or more. Industrial spaces, office space is like 25, 30%, 50% in areas right now. There was such a downsize in office. So retail is very limited with how much vacancy is out there. So that's why the play. So you have a few different things here. You have, it used to be 220 million coming to market every year, and now it's 30 million. You have an entire shift in retail from selling goods and physical products to now selling services, fitness, health and wellness, and experiences and so forth. Everything from a hair salon, a blowout bar, a nail salon, a place to get something to eat, an escape room, a cold plunge, a sauna place, yoga studio, Pilates. I mean, go on and on and on. That's what you have now. So you have the limited supply being built, a huge demand for these new businesses that are trending right now. You have a low supply that's existing. You have a tired product that most retail centers haven't been maintained in 30 years or 40 years. So they need a facelift. And everything that's existing right now, 95% of it is below market rents. So that is, if you don't need to be a genius to understand that you have 1, 2, 3, 4, 5. It's everything is trending where this is the play. This is what people want to do. Now, a big thing is, why is it being ignored? It's actually not being ignored right now from people that that are in my industry. It's just not mainstream as much yet. There was a saying that someone told me a long time ago, and I think it's true, is that if you're in a cab and your cab driver gives you a stock tip, it's time to sell that stock. That's kind of what it is. Everybody was into multifamily and the other ones that I mentioned earlier. So retail is actually going to be the self-storage of the multifamily of the future. It's in 10, 15 years from now, that's what everybody's going to talk about. How did I not acquire that strip center down the street? It's very easy to do so because they have what's called a DSCR loan, which is debt service coverage ratio. So if something's producing income, let's say $100,000 a year, as long as it's 1.25 or 1.3 times what your mortgage will be, you can get a loan on it. So if it's producing 100,000 and your loan's only going to be 70,000 or something like that, 75,000, you're going to end up getting approved to buy it. And because it's retail triple net leases, the leases kind of take care of themselves in a way. You have to put management in place. You have to do a lot of things. It's not passive to acquire it. It's not passive to set it up. There's stuff that needs to go involved. It's actually work, but it pays very well. And you can have credit tenants. You can have things like that really improve the value. You could have a mom and pop coffee shop or a Starbucks, and they're paying the same rent, and one gives you a greater value. So here's where the contrarian magic kind of really kicks in, is no one's paying attention to small retail right now. So the acquisition competition is a lot less. And I think that's a really big deal. When you have a lot of competition trying to buy an income producing property, any sort of commercial asset, basically the person's willing to pay the most is what's going to win it. That is not really makes you feel a good feeling when you acquire something and you know that 10 other people weren't willing to pay as much as you were. That just makes you feel like, oh shoot, I overpaid, I missed something. So having low competition is something that I really look for. And there's really high cap rates right now. And you can buy retail centers and strip centers for 7.5, 8 caps going in. That's not even including the fact that you can raise the rents, redo the center, and you're building into a 10 or 11 cap or more. So that's like a really big deal, or something that I really look for. And an example is that we bought just last year, about 18 months ago, we bought a center in Southern California here for $8.4 million, and it was outdated, it was under leased, it had some real cosmetic issues with it. And in under 2 years, we leased it to Habit Burger, O'Reilly Auto Parts, California Fish Grill, Mattress Firm, Pacific Dental, a bunch of other tenants, and we ended up turning it into a center worth $26 million. So that's quite the return. Now, we had to put a lot of money into it. It's almost a $7 million renovation, and that's, I'm not suggesting if it's your very first strip center that you go into something with that big of a lift and that big of a project, but you can find something for $1 million or $2 million or less than that in your neighborhood that has 4 or 5 small mom and pop spaces, and put a new storefront in, redo like the roofs, the parking lot, some landscaping, and slowly start to raise the rents a little bit, and you're gonna make a killing. It's really kind of an overlooked asset class. And if you're an investor that's invested currently in multifamily, or or Airbnb, you already know the things that are a pain in the ass about that. Like multifamily is the turnover, right? You're going to have turnover constantly, and you're going to have things that are breaking constantly in the units and the repair costs and so forth, and it really becomes a pain. And if you are operating Airbnb right now or Vrbo, any of that short-term rental type of thing, that's a job. That's an active job in hospitality where you're working every day, trying to find new guests to stay and cleaning it constantly and refreshing. That's a full-time job, in my opinion. If you're smarter than I am and have it completely automated, I mean, good for you. That's not exactly passive. So those are the reasons. And if you really want to be passive, retail, there's a lot of syndications for that as well, where there's like these big opportunities where people are doing $20-30 million deals and they only take a few years, and the tenants are already locked in place before they put in a shovel in the ground. And when that's the case, it de-escalates that risk so much that I recommend that as well. Every cycle, no matter what we are talking about, from the tulip bulbs back in Holland hundreds of years ago, to the dot-com bubble, to the housing of 2007, 2008, it doesn't matter what cycle it is. It has a beginning and it has an end. There's a wave, and right now the retail is at the tip of this wave. It's that precipice. That's really what I wanted to make this video about, is that it is in the middle of the wave, but people aren't seeing it yet, and they will in the future. Just like, wouldn't you wish you bought Bitcoin when it was $1 and you didn't, and then you kick yourself about it? That's kind of the same thing with this. Is rents right now in my neighborhood, just if I look outside, are $1.50 a square foot, and once the center is being rebuilt, they're $5 a square foot. And the tenants are willing to pay this because they're businesses, and their business can justify that rent because they're making so much money selling hamburgers or dry cleaning or yoga, whatever they're doing. Their business is generated enough to justify this rent. So it's not like you're gouging someone that's trying to find a place to live. That's not how this is. This is a business that's operating and can produce more income, and they don't even think twice about paying the rent because their business can be thriving. And if you do a center the right way with the proper co-tenancy and the aesthetics, you're helping that business succeed and making them more money. So it's kind of a win-win for everybody. It's a rare moment that you can look smart jumping in on something a little earlier than everybody else, and everybody else will be there eventually. So if this helped open your eyes to what's going on in the commercial real estate and what asset class you'd really benefit from, please hit the like and subscribe button so we can keep making more of these videos, and hopefully we just can shine the light on a lot of just aspects of commercial real estate that go overlooked, or they're not big and fancy and shiny like building new high-rises and baseball stadiums. They're just small plays that can generate a lot of wealth, and wanted to kind of put the spotlight on that to see if anybody could take advantage of it. And here's the bonus that I promised. Click the link in my bio in the description. It is the free retail investment quick start guide. It's a simple breakdown of how to elevate neighborhood retail centers and spot value add property. Okay, it's a lot of value in there. It's a lot of just some tips, a little checklist on how to go spot an opportunity. So I'll see you in the next video, and trust me, this is just the beginning. Thanks.